Oil prices rose today after rebounding from a brief decline as traders assess the limited impact of reduced Venezuelan supply in what is considered to be an already oversupplied market. Let's go to Rebecca Babin. She's senior energy trader at CIBC Private Wealth and joins us now to talk some more. Thanks for your time.
Thanks for having me.
Okay, oil prices up, but a limited move here, despite the Venezuelan supply being off market, I guess. What does this indicate about the need for the product from Venezuela?
So I think what the price action today indicates is two things. And the first is that positioning coming into today was extremely bearish. Managed money for Brent shorts was at a 10-year high, whereas WTI longs were at a decade low. So we're seeing a reaction and we've seen increased uncertainty. I think if you listen to everyone talk right now, we're not hearing about a defined plan, and we don't exactly know if we're going to see an increase in Venezuelan crude in the short term or a decrease. And when we have increased uncertainty, if positioning is extended, traders are going to unwind that position. So in this case, that's a cover of a short. I don't think the market's telling us that we're going to see a massive decrease in Venezuelan supply in the short term. You know, they were only producing 900,000 barrels a day of crude. We'd already knocked off around 300,000 barrels leading up to this event with sanctions. We could lose another 200,000 to 300,000 barrels in the coming weeks. But in the context of a market that's oversupplied by over 1.5 million barrels a day, that's not enough to force prices higher. So it's really, I think, a positioning-based rally at the moment. And secondly, maybe just a turning up of the heat of geopolitical risks broadly, right? We have protests in Iran. We've had some headlines from Netanyahu regarding Iran rebuilding their nuclear capabilities. And so this isn't happening in isolation. We also have China and Russia, who are direct investors in Venezuela, and we need to see how things unfold with them. So I think this is uncertainty, geopolitical risk, and positioning, because we are a well-supplied market, and losing 300,000 to 500,000 additional barrels isn't enough to create a sustainable rally.
As you know, the U.S. president wants American companies to come in, rebuild some of the infrastructure. He puts it as sort of reclaiming the debts that they are owed. What challenges could American companies face trying to rebuild in Venezuela?
So there's several challenges, and the first is just the amount of investment it would take to get there. Now, if we talk about this, we should talk about it in two tiers. The first, like 500,000 to 1 million barrels of increased output in Venezuela that would come in the neighborhood of 1.5 to 5 years, isn't as big of an investment as when we talk about increasing production back to that kind of 3 million barrel a day mark. So if that first 500,000 barrels really comes at an investment of around $15 to $20 billion over 5-7 years, which may be manageable. You're looking at reinvesting in existing infrastructure and reworking supply that way. If you want to talk about that next tier of supply, getting back to 3 million barrels a day of production, and that is a 5 to 10 year time horizon, you're looking at investments of over $100 billion. Last year in 2025, U.S. production cost capex of around $60 billion. So it's a big number. So that's the key and number one kind of challenge of going back into Venezuela, is just that cost. The second is the clarity. These are long-term investments. How do you know that you're going to have sustained consistent laws, regulation above the ground to make that type of investment? And that's, I think, the second big barrier is how do you get that confirmation of long-term stability?
Okay. And, you know, if you're a big oil producer in the U.S. and you're invited by the Trump administration to do it, saying that they will support you, would it be worth the risk? At what point would it be worth the risk?
So that's a really good question. And it's going to be worth the risk when the return on investment from making that investment is greater than the return on that, putting that CapEx dollar into a different project, right? So when we look at the back end of the crude curve right now, it's not falling apart. It's not that much lower based on a potential of increased Venezuela supply, because U.S. companies have been so capital disciplined that the traders are looking at this and saying, okay, if that CapEx dollar goes to Venezuela, does it mean it's taken from somewhere else. And it's going to be that return on investment that drives that decision, and confidence in the stability of the laws and regulations in Venezuela. So it's also going to require some confidence of crude being kind of in the range of $60 to $70, and not kind of closer to the $50 or $40 level. So there's a lot of factors. And I think the reason that we're not seeing the back end of the crude curve fall or respond to this is that there's just not a tremendous amount of confidence that that dollar goes to increasing Venezuela crude in a 10-year time horizon with this much uncertainty.
Okay.
We could get more information that changes that, but right now, traders aren't willing to make that bet.
Is this a concern for shale producers in the U.S. Longer term?
Sure. Yes. In the very long term, if it's a perfect world and we do get the laws and regulation in Venezuela and it makes sense to put that dollar there, it's going to increase production in that scenario. And that would drive crude lower, and shale producers would then be priced out of the market. They're looking at break evens closer to $50. Break evens in Venezuela obviously would be lower once those investments have been made. So it would pressure that. And I think you are seeing that in the equities today. You're seeing a bifurcation of how equities are responding. Some U.S. producers are lower. Oil services are higher. So you're starting to see a little bit of that bleed into the market. But I still think, in general, the crude market is taking a very conservative approach to pricing in additional barrels.
Rebecca Babin, got to leave it there. But thank you for your time. Thanks for joining us on the program.
Thank you.